Hey there, everyone. This is Sean, and welcome to Questioning Money, a newsletter taking a closer look at how money works and how it affects the world around us. Today, I'm going to take a look in the direction that money is heading in the future and discuss the idea of central bank digital currencies. So the way that the banking system works now is that individuals like us have bank accounts, and those banks have accounts with the Federal Reserve. Now, our money's pretty much digital anyway, right? Most of us just don't use cash anymore. In fact, cash makes up less than 10% of all US dollar transactions. So what's the difference between a credit-debit banking system that we have today and the idea of a central bank digital currency, which I may abbreviate from here on as a CBDC? When we do digital transactions today, or we use our money that's saved in the bank at all, our money is really just an entry in a digital accounting ledger. Banks just add to and decrease the numbers as we make deposits and send money. The numbers have to add up, of course, but that's really the extent of how digital money works. A central bank digital currency would be something that's more like Venmo. You would have a wallet app on your phone that could receive deposits and send out payments for transactions. The difference is that instead of where you connect Venmo to a bank, with a central bank digital currency, the Venmo-like app itself would be your own personal bank with the Federal Reserve. Now, it remains to be seen how a system like this would actually be implemented, because the Federal Reserve obviously doesn't want to put all banks out of business. We'll probably find a way to keep the banks involved as an unnecessary intermediary, but with a CBDC, a bank itself isn't really needed. You would have this app that's your personal wallet that you could receive paychecks directly to, pay for milk at the grocery store, and send money to your friends just as easily as you could with Venmo. If you've ever used Bitcoin, you're also familiar of a base layer money being digital. So why would we want CBDCs? Well, first, it's just easier for the user. Venmo is obviously much easier to use when paying your friend for dinner than setting up a wire transfer would be. Our banking system is more than 50 years old, it's slow and creaky, and it's simply not efficient. With a CBDC, payments and banking would be thrust into the 21st century. So let's get into more about how money is going to develop in the future. For starters, with a CBDC, taxes could get automatically deducted from your wallet. Since the central bank and the government would have direct access and control over your money in a way that is far beyond the current banking system, they would be able to have a simple calculation that measures your taxes and automatically deducts them from your wallet. Kind of cool, but also a little scary, right? While banks do freeze accounts now, with a CBDC, a government could press a button and cut off access to your entire life savings if you're suspected of a crime. With CBDCs, you can never actually own your own money. At any given moment, with essentially the snap of a finger, your money could be instantly frozen, confiscated, and seized. If you get a parking ticket and you miss the court date, that ticket money will just be zooped out of your account. This can be seen in China, which is very likely the country that will have the first central bank digital currency. It's been rumored for years and numerous leaks have been posted on the internet. China is certainly going to use their CBDC for nefarious purposes, namely the continued oppression and surveillance of its 1.5 billion person population. In the United States, we can hope and think that it won't be as bad, but it's important to understand the potential abuse that is possible in a system like this. And throughout history, we've seen conclusively that if something can be abused, eventually it will. Let's get back to thinking about what CBDCs mean from a financial perspective. The ease with tax collection, as I mentioned before, would certainly be possible. You'll also see the possibility for things like stimulus payments to be deposited much easier into a CBDC wallet account than it has been to mail people checks or direct deposits. And what goes with that is the clear trend that we're heading in towards some form of universal basic income eventually getting passed. Now, I think that UBI would greatly increase inequality further, as well as making our fragile debt-based economy even more fragile and debt-based, which is maybe the topic of a future Questioning Money. But to me, it certainly seems like universal basic income in some form is going to happen, and sooner than probably most of us think. CBDCs also offer significant new potential for interest rate management. Since interest rates would be more centrally controlled directly than they are now, it would be trivial for the central bank to offer different interest rates for different groups. Individuals might get one interest rate, corporations and investment firms might get other interest rates, and foreign governments might get different interest rates when borrowing from the Fed. And continuing on interest rates further, CBDCs make it much easier to impose negative interest rates. For those that don't know, a negative interest rate would mean that, for example, if you took a loan out from the bank for $1,000, you would only have to pay back $990, essentially free money. Great for borrowers, but the same principle applies for savers. In a negative interest rate world, you would put $1,000 in the bank, but after a year, you would only have $990, essentially paying to keep your money in the bank. The Federal Reserve has said numerous times that they will not go negative with interest rates, but it's clearly the direction that we're heading in. Across the world, many countries already do this. There's currently $18 trillion worth of negative interest rate yielding debt worldwide. As I talked about in QM9, a debt-based economy, our economy needs more debt than ever to function right now. Interest rates in the US are already at near zero. Usually, this is when the central bank is out of ammo. Now, though, we're going to see them turn interest rates negative as a means to encourage more borrowing and more debt further by literally charging you to store money in the bank. CBDCs make doing this easier because if the Fed imposed this now, people would run to the bank and withdraw their money in cash to avoid having to pay a negative interest rate. Now, the European Central Bank has already announced that they are exploring the possibility of a digital euro, and you'll hear those bankers talk about how CBDCs can work in conjunction with cash. And maybe in the short term that's true, but it's obvious that CBDC lays down the groundwork for the total eradication of cash. And that's about all I wanted to cover in this issue of Questioning Money. CBDCs are coming. First in China, then in Europe, and then probably to America. Some of what they offer is really interesting, and I didn't even get to cover some of the things I would have liked to have talked about. CBDCs offer genuinely interesting potential to significantly change monetary and fiscal policy moving forward. But some of these changes are not necessarily good. It remains to be seen, and there are also real risks about how a system like this could be abused. So thank you for listening. You can find me on Twitter at Sean Cover. If you like the newsletter, please subscribe to get it sent directly to your email inbox, and I'll talk to you all soon. Take care.